After the trip, they walked away reversing that view, that they are short-term negative and long-term positive.
Amazing.
Why short-term negative? Is because, like I said, they were expecting this bazooka and the stimulus. They realized it's not coming through.
Yeah.
But they're long-term positive because, well, despite
So let's bucket the allocators that we're looking at right now. Okay, just sort of comparing notes, right? Ever since November, we've been fielding a lot of US allocators. I won't name names, Canadians, Americans, a lot of Europeans coming to town. They're building their research on the type of managers that they want to deploy. Number one, the strategy that they seem to be leaning towards is more long biased, simply because we're coming out of the trough. Oh, and secondly is they prefer to deploy via a pan-Asia strategy. But thirdly is they're all very scared of missing out on the right side of the curve, right? The left side tail, they said that's taking care of itself already.
Yeah.
They're all really scared of missing out on the right side of the curve. And so this implies that if the market were to move and to rebound, it'll move really, really quickly. What are you guys looking for? And I know you're fundamental based, but it's hard to be purely fundamental after the last 5 years. Right. Even for us, like I come from a P background, I've kind of become a card-carrying macro guy in the last 5 years, just because otherwise it's impossible, right? It's unbearable. So what are you looking at as triggers, or what are you looking for, either from a policy level, are you looking at metrics, are you looking at, could be on a sectoral basis, what are you looking at to trigger that turn that you think, you know what, now's the time, we're going to be at an inflection point, you're going to pick up that phone, you're going to call all the ISOs, say, now you have to put your money in today.
Yeah. I mean, honestly, in some ways, I have been making that call for the past few months now. Not so much because I feel like I am telling them that I know exactly what's going to pan out. It's more from a downside perspective that I do think we have hit a bottom.
Okay, so you have RV. RV looks good.
Yeah.
Downside's taking care of itself. I was in an argument with someone on Twitter or on one of the social media feeds, and I pointed this out. I said, from an RV level, we've hit the bottom. And the heckler came in and he said, well, what's going to drive forward momentum? Sure, you have great, discounted value here, but what's going to drive valuations forward? Not necessarily calling it when's the growth story going to come back?
Yeah.
Well, what are you looking for?
So if I have to pinpoint on one thing, and I actually most recently wrote about this, it's all about the property.
Okay.
It still all comes down to property. Why? So if you consider the fact that not only with the real estate sector drives up to a quarter of China's GDP, it's also 70%, more than 70% of household wealth. Everything that we have seen in China today, slowing consumption, increasing savings, people are just downgrading their whatever it is that they're buying. All comes down to the fact that they don't feel secure about their wealth. And why not? It's because the real estate market continues to go down. So in my opinion, it's all about the property. Now, here I think is where the nuance comes in. Everyone that I've spoken with over the past 18 months, we're looking for this bazooka where the government come in. So very similar to maybe because they still remember in 2008, government did this 4 trillion stimulus and so everyone is still looking for that in China, which I don't think is going to happen. I really don't believe that is the
no way.
The goal.
Exactly. They can't. And you pointed right there. 2008, $4 trillion, which now ballooned to $20 trillion over the last 10 years.
Yeah.
Right. 70% of the US dollars in circulation, if not more, were printed in the last decade.
Yeah.
Since the history of the United States dollar.
Exactly. So
I don't think the Chinese are going to want to do that.
Not at all.
I'm saying.
Their goal is to stabilize the real estate sector. What does stabilization means? It means essentially clearing out the inventory, the excess inventory, ensuring that the price at least set a floor for the price so that the price doesn't keep falling and people just doesn't know what to do with that. And because of that, and hence why I said I do think the market has hit a bottom, is because I do think where we are at a point where the government has already set a red line as to just how much pain they're willing to take from the real estate sector.
So let's go into a couple of things that came out. All right, last month, just 3 weeks ago, they announced $52 billion facility for institutions to buy banking and some of the non-banking institutions that will allow them to buy these properties or these assets that are kind of ghosted in the market.
Yeah.
There's about 20 million units of these, at least an estimate, right? How does an investor conceptualize where we are on the uptake curve here, on the recovery cycle?
Yeah.
It's a lot of property.
It is.
Right.
It is.
I'd like to argue that unlike the Lehman bonds, which is paper, unpriceable,
Yeah.
property is always priceable. It may take time, but you can't put a price on it. Once that discovery takes place, in my opinion, is when you can start looking at the bottom.
Yeah.
Are we there yet? I mean, is it enough? Because that's the big question. As you said, is $52 billion enough?
Yeah, so I have seen different analysis around this. The people drew comparison of the U.S. housing crisis, the Spain housing crisis, the Japanese housing crisis, and then try to plot where China is relative to all those crises, and we're basically in halfway.
Okay.
But I'm a little bit uncertain if that is a good analogy to draw, simply because I believe no one really knows, even the government really knows what the right equilibrium is for the China housing sector, because it has been on a one-way street for decades, to the point where you don't even know where demand actually is supposed to be supply.
Yeah.
So, if you look at actual inventory and at current stage, we are already back to pre-COVID period, probably 2018, 2017 levels. Is that the right amount? I don't know. Actually, I don't think anyone knows. Nobody can really tell you exactly what is the right amount. Even if you draw all these comparisons from other parts of the world, it doesn't, in my opinion, doesn't really say too much. But that's why I think it's much more important to read it from, okay, just whether or not the government will allow this to continue worsen. And so essentially that red line that I talked about.
Yeah.
What is the red line that's been set? And the fact that this past month, where the state council has stated that the real estate market is critically important to general public interest, and the central bank now are lending money to local banks so that they can, and these money are all earmarked and mandated that they are only able to lend to developers or actually use them to buy unsold homes.
Yes.
I read that as that it's no longer an economic issue, it's a political issue.
Right.
Now, if it's become a political issue, that is the red line. If that is the red line, then I do think you can safe to assume that it doesn't. I don't know what the equilibrium is, but
it's going to work itself.
It's gonna work itself out, because it has now become something that the party has decided to fix. And like we talked about, whatever the party has set out to do over the past few years, they have done.
It's telegraphed it.
Exactly. Yeah. So I would look at it from more of that angle, because really trying to time that bottom and call, what that inventory level should look like, I think it's a fool's errand. I mean, nobody really knows, because China has just been on this one-way rise over the decades.
Last question. It's a stock picker's market. Everyone knows this. And I think general consensus is a stock picker's market. So when we look at China, it's no longer broad stroke. You're going to see 15% year-on-year growth and inflation numbers to match it. This is not the case. And perhaps there's something in that that's formulaic that has to do with the uptake and the digestion of the supply in the property market. But coming back to this point, are these still the areas that you're bullish on? So we're talking about bleeding edge innovation. We're talking about advanced manufacturing, ESG. Right? By ESG, I actually really mean just EV and solar, green tech, and then consumer.
Yeah.
The first two or three, I totally get it. Consumer demand, is that still linked to property, or do you see a turning point here?
Yeah, I opened with how it's important to get the trend right. And all the things that you just mentioned, the trend is still there, but there are a lot of, from our investment style, we don't want to touch, especially areas where it's very much driven by the state. State money is being pumped in and the SOEs are getting involved. This is an area that we want to avoid. But you still want to be able to play that rising trend like EV, renewable. So picks and shuffles are probably the better way to go at it from our perspective. We like component makers that supply for the industry. Inverter plays within the renewable. Air conditioning units and EV cars for EV. Power grid, as I talked about, those transformer makers is something that we like. So the industrial side, the manufacturing side, is a lot more picks and shuffles that are benefiting from all these mega trends that are now being developed, and China is leading the rest of the world. The consumer bit, I think, is a little bit more complicated in the sense that, yes, there is a consumption slowdown. I really believe that's only half the story. There's also a permanent shift in consumption behavior driven by everything that's happened over the past few years, especially the zero COVID policy. You see people have a shift in what they deem as value in their life. So I don't think housing is going to be that anymore.
Right.
You look at what areas within consumer is still booming. All these are much more experiential. Tourism,
Yep.
it's been doing really well.
Yep.
Well-being is a big sector, but well-being includes things like supplements, vitamins, even pet industry, Chinese medicine, and then you have the physical sports activities, yoga. I mean, these are all areas within consumption sector that are still booming and rising, and many of them actually are very expensive in terms of the product that they're selling relative to the rest of the world. So I do think when it comes to consumption, it's even more of a stock picker market now. You really need to be able to identify those few companies that are operating within those specific sub-industries that are still booming, and they're able to essentially grow along with it.
It comes down to this 40% savings rate that's still here post-COVID, that's holding the rebound back in full.
Oh, yes.
I feel like.
And it's rising.
And it's rising.
Yeah.
But at the same time, it's captive capital that needs to be monetized at some point. It needs to be released either through a shift or behavioral change in the consumer dynamics, perhaps increasing the robustness of a credit culture that had driven the U.S. into where it is today, a revolving credit door basically. But the culture in China is still very, very prudent at a household level. And these different facets of spending, it seems very, very difficult to gauge which one will, which sectors will unlock it en masse, right? At least something that you could take a 5-10 year view on. So I agree. I think we're still early right now.
Yeah.
Let me sort of start to talk a little bit about Hong Kong and where Hong Kong is, right? Hong Kong has kind of outpaced China. It's kind of coming out of the rebound a little bit faster. But you probably saw this big viral discussion with Steve Roach and the judges leaving Hong Kong.
Yeah. Mark Mobius was involved as well.
Yeah, that's right. So there's a lot of FUD coming through this town. It seems never ending. But you and I sitting here, we've been here for ages. I've been here for almost since 99, 2000. The impact of my life of all of these things have really been so marginal, they're not even considered material, whether it be to my freedom or whatever. All these changes and shifts from the British coming, the British going. The handover in 97 I was here for, straight through till, watching the riots and the protesters happen in the last 5 years. It hasn't materially changed anything in my life. And yet, it seems from the outside looking in, Hong Kong has changed dramatically. And yes, it has from a tourism perspective. And, some of the teams that we know have moved to Singapore, but some of them are actually trying to come back.
Yeah.
So take a step back. Where is Hong Kong for you, both as an investment manager and an investor?
I agree with everything you said, Alvin. I don't think the political changes that we have seen in Hong Kong, frankly speaking, I don't think it really affected players like ourselves too much. In fact, it's hardly noticeable. The only thing that may have an impact, which, is of course the geopolitical tension against China, and Hong Kong has always been that doorway into China, and a drying up of liquidity, the sentiment being worsening, have an impact on the overall industry. But that's also the point that I want to make, which is, Hong Kong has always been the gateway to China. That is its bread and butter. That is its unique advantage. And from my perspective, as long as China isn't completely written off from the rest of the world, and frankly, it's impossible to do that anyway, given its integration of global supply chain and everything, Hong Kong will always have that angle and will always be fine. And from an investment management perspective, in my opinion, you really get the best of both worlds being here. We invest in A shares via the Stock Connect. And we actually find that to be the preferred way for most global investors anyway. Right. You don't have to put money directly into China via the QFII, which there are a lot of capital control issues and worries around that. And you park everything here where the Hong Kong dollar is still pegged to the US dollar. So it's easily fungible and you can just do whatever it is that you need to do.
It's still the number one regulator in the region.
Correct.
We're still 4 times the size of Singapore in AUM.
Yeah.
In terms of, private funds and hedge fund space.
Exactly. So I do think the financial sector in Hong Kong is having a difficult period right now because of, all the issues related to China. But hasn't really eroded the positioning that Hong Kong plays. It is still going to be the main gateway into the world's second largest economy, on track to become the largest economy in the world. I mean, that's no other way to do that. There was a period of time where, this is, when I was in Shanghai, where I felt like Shanghai was on track to displace Hong Kong from that positioning.
And what was this?
This was 2015, 2014, probably beginning of the 2010s, all the way up until...
I think I know what you're talking about. Tell me, what was it that triggered that feeling when you were in...
Oh, many. I mean, at that time, you probably recall there was this big push on the free trade zone.
Yeah.
And really opening that up and having the RMB to be, kind of free floating within that space. There were a lot of local incentives from the Pudong government attracting financial companies to open there.
Incredible. Right?
And Shanghai is the default financial center for China.
Yeah.
So it makes a lot of sense for them to do that.
It was the first time that Shanghai had overtaken Hong Kong as a trade port.
Yes, correct.
Turnover. And so all of the leasing contracts and all of the financial instruments on the back of trade were quickly shifting towards Shanghai as a result.
Exactly.
That to me was exactly 2014-15 that it struck me. And for the first time, I thought, wow, Hong Kong might actually be threatened.
Yeah. You also probably remember at that time, they were also loading up on allowing domestic investors to also invest overseas, with things like QDLP, QDII. And then there was also another scheme specific to the free trade zone, which I fail to recall now, where you can literally get the money outside. So that was, in my opinion, I thought that was the start where Shanghai will gradually displace Hong Kong as sort of that international hub. In some ways, we have zero COVID to thank. I do think zero COVID, the lockdown that we have seen in Shanghai, that basically killed that dream.
Yeah.
Where it actually helped Hong Kong to remain to be the only sort of gateway into China. So I think from a financial sector perspective, anyone within this industry, just hang in there. I think it'll work itself out.
Do you get pressure from investors to move to Singapore?
Nope.
Yeah.
Yeah, not one. I mean, there were a lot of questions whether or not we have that plan. But once you explain to them the benefit of being here and kind of just tell them a little bit about the different systems, and honestly, not much has changed. No one really bothers you on that, because for a China manager, it also makes very little sense to be based in Singapore. Yeah. There's still this big disconnect. You can't access the country, China, as easily as being in Hong Kong. I just came back from Xiamen this past weekend. 2.5 hours from Shenzhen to Xiamen.
Amazing.
High-speed rail. And from here to Shenzhen, it's only 14 minutes. So
14 minutes.
14 minutes, right? So
1-4.
Exactly.
It used to take an hour and a bit.
Exactly. So within 3 hours, I was able to go from Hong Kong to Xiamen, which is, Fujian province, and that's already halfway to Shanghai. So being in Singapore, you will never be able to do that.
They have high-speed rail in Tibet right now.
Oh, do they really?
Yeah.
Oh, wow.
They don't even have high-speed rail in LA, and they have high-speed rail in Tibet already.
There you go. The infrastructure in China really is quite world-class. And one of the initiatives that I have been planning for us as a company is to really invite more allocators to come to China to see for themselves. It's not about taking them to see companies and whatnot. Honestly, you can find great companies all over the world. You can find it in the US, you can find it in Europe. Right now, allocators need to make a decision on China. And for them to make a better decision, they need to get first-hand experience, in my opinion, and really see China for itself. And that's something that we've been doing, which is to invite allocators to come to China with us. And we just show them. We take them to these lower tier cities via the high-speed rail.
Yep.
And you see for yourself whether or not it aligns with what you hear reading from the Financial Times or the Economist. And more often than not, they walk away shocked, surprised, and actually changes the overall views. And this point on this trip we just did in the beginning of January with one of the largest pension clients that we have. And they came to China with a view that they're going to be short-term positive and long-term negative. Short-term positive because it's so cheap. They feel like there ought to be some rebound within the market. Long-term negative because they just don't believe in the China story anymore. We took them deep into China in tier 2, 3, and 4 cities. We spent a couple of days there. We interviewed local government officials. We took them to visit different hospitals, looking at the equipment, going to shopping malls to get a pulse check on the consumer sentiment. After the trip, they walked away reversing that view, that they are short-term negative and long-term positive.
Amazing.
Why short-term negative is because, like I said, they were expecting this bazooka and the stimulus. They realized it's not coming through.
Yeah.
But they're long-term positive because, well, despite everything that they know, the slowdown and everything, there's still so many pockets of opportunities. And honestly, things are not as bad as what you would normally read. Yeah. We still see people holding multiple bags in the shopping malls, just buying things. The infrastructure blew them away. This is a client from Europe. So you can imagine from a comparison perspective how mesmerized they were.
What was it? Was it the cashless society?
Yeah.
Was it the 90% EV rate on the road that impressed them?
Yeah. Digitalization, definitely.
Yeah.
How they've seen how we essentially did everything with just our phone.
Yeah.
No cash, completely cashless on the entire trip. The fact that we're able to travel one point to another across huge distances, less than the amount of time needed to fly via the high-speed rail.
Yeah.
That's also, something that is just blows them away.
When you look at, and maybe this is a great way to sort of wind things down, when you look at your career, you've been CEO of one of the longest standing funds in Hong Kong. You were educated in the West. If you were to start your career today, coming out of school, would you do it here now in the middle of all of this FUD and US-Sino conflict, or would you take it back, to London or New York?
I would absolutely do it right now here. And the reason is because I actually started out my career just before the great financial crisis. And going through that motion is extremely painful. You probably will hate every single second of it, but the experience, the exposure, just the overall knowledge that you would gain in crisis is bar none. And that will fast track your career so much more than starting in a bull market, in a time when everything is fine and dandy.
You get the t-shirt that says, I made it through, I survived, I thrived in a bear market.
Exactly. And I do think right now, if you're starting out and being here, where there's so many things going on, and essentially at the center of almost a tectonic shift of global regimes, it's the best thing you can do for yourself in your career.
Steve, you still reading these days? Reading any good books?
Yes.
Yeah.
I actually just finished the book, The Outsiders.
Okay.
It's about 8 unconventional CEOs and how they've generated significant shareholder returns over the years. And it's actually the number 1 recommended book by Warren Buffett. So definitely
go check
that out.
Yeah. Steve, it's always a pleasure to sit down with you and chat. Why don't we check in again in a couple of months?
Yes.
And maybe we'll work together on getting some allocators over. We'll take them on a trip.
I would love that, Alvin. Thank you for the opportunity.
I'll talk to you soon.
Thank you.